My name's Sheena Carter. I was appointed to the New South Wales DPI as a Dairy Development Officer in March of this year, having been with Dairy New South Wales an extension for the previous 7. So I head up the Dairy Business Advisory Unit with the dairy team, and part of that role is coordinating the New South Wales Dairy Farm Monitor Project. Since Kerry Kempton retired towards the end of the year. So I've inherited a good legacy from Kerry Kempton, who's run this program really well over the previous 8 years. It's now the 9th year in New South Wales. So I'd also like to I always do my thank yous at the beginning of my presentation because I always forget to at the end, but I would like to very much thank the farmers in particular that provide their information, physicals and financials that enables us to run this report, and also the data collectors who get out on farm and do this with them. And also Jake, who is online with us today, Jake Musson, Helen Quinn and Fiona Smith, who are integral into getting the results finalised and verified so that we can pull the report together and do these presentations back to industry. So thank you to them. Okay, just a bit of the background. It's part of the National Dairy Farm Monitor project in New South Wales, in Australia, and it's now the 9th year that we've run it in New South Wales, which is fantastic, and we've got some really good sort of trend data that we can show over time because of that. This year we had 35 farms participate. We saw 6 farms opt to not participate this year, and we picked up another 9, which was fantastic. The information sits behind Dairybase and provides some of that rigorous data that is used from comparisons and things like that. And I should have mentioned that the project is a joint project between New South Wales DPI and Dairy Australia. It's used widely because it gives us a good, impartial and accurate picture of the performance of the industry across the year and across time, showing us how sort of farmers respond to those external and internal forces in their business, input costs, prices, all those sorts of things. And it also shows within New South Wales the variation that we have across such a large dairying region. It's used by government in sort of strategy and policy. It's used by Dairy Australia to inform things like Dairy Plan and the Situation and Outlook Report. It's used by the regional development programs across the state. We've got 3 in New South Wales, and you'll see other consultants and people using it in things that they're reporting on or analysing. So it is very widely used. This map gives you an indication of where the farms are in New South Wales. So you can see that we've got good distribution across the state in terms of location of farms in all our major dairying regions. In New South Wales, we split the data sets into north and south farms. This is primarily based sort of on system, and obviously there's climatic factors involved there as well. And as you'll see, the southern farms tend to be larger farms than the northern coastal farms. So we had 18 farms in the north and 17 farms in the south for the data set. Now, before we jump into the results, I just want to sort of do a bit of contexting. I was expecting a particularly poor performance on the back of the 18-19 year that we had. Obviously, it was our 3rd year in drought across the state, so it was a tough year. But as the results and the files started coming in, it was quite interesting. There was some quite good results coming in. Obviously, there's variation with all the data sets, but in the main, the results were quite promising. But I want to just sort of, caveat this with how people actually felt. I think the numbers are one thing, but there's a human factor to this too. And we had a really tough year on the back of 2 previous tough years. Not only did we get this little thing pop up and affect sort of, supply and service provider access on some farms, but we've also had fires, up and down the whole length of the state, which were devastating and did affect some of our farm monitor farms and some of their result, and obviously other farms across the state. And also, the 3rd year of drought, which this is a dairy farm in Wingham, and you can see, devastating effect of drought and a bit of smoke haze on top. So, cash flows were really tested, equity was drawn down on, but the human reserves were drawn down on too. So it was a really tough year for people themselves, but on the whole, financially good results. Just to context the season in that financial year, this is the rainfall decile over the 12-month period of the financial year. I don't think this reflects what I've just spoken about. It's showing that the average, so it shows the relative rainfall to the average, and indicating that there was average to very much below average rainfall across the state, particularly in that south. The white patches that we see sort of up in the north here and around Sydney are really a result of that heavy autumn rain in the second half of the year, thankfully. This map is called a combined drought indicator. This factors in soil moisture, rainfall, and some crop growth factors to give an indication of effective rainfall. And again, this is averaged over the 12-month period. And we can really see sort of how tough it was down in the far south of the state, around that Bega region, with their autumn rainfall didn't quite come as it did in the north. But I think, to me, this is what people felt and remember. This was in January, when we had all of New South Wales was in some form of drought at that point. And not only New South Wales, but most of the country. So it was incredibly severe. With the farm monitor farms, we look at their rainfall data. If they don't have actual rainfall data themselves, we get the figures from the nearest BOM station. So we can have a look at the average rainfall across the northern data set and the southern data set. This is the north, and we can see obviously that severe deficit of rain in the first, well, 2/3 of the year anyway, and then it was when autumn came, we finally saw some, well, very heavy rainfalls, but some good rainfall in the north of the state, with some good follow-up leading into winter. The south is very much the same pattern, but the impact of that autumn rainfall wasn't as strong on average compared to the north. And I think, it's really low here, but that line really obviously goes back into the previous financial year as well. This spike in the autumn rainfall was, very well or gratefully received, and it did give people the ability to conserve some fodder, so to finally make some hay and silage and put some of their own homegrown feed in their sheds instead of purchased feed, particularly in the north. But also it was, a good timing for pasture innovation and pasture growth in general. Some of the physical characteristics of the farms in the data set. So this shows the average figures across the state, but also split into north and south. And so we can see that in the south, a higher production per cow in terms of solids per cow, which also translates with litres. In terms of homegrown feed, so this is calculated according to energy, but the percentage of homegrown feed in the diet at 51% was the lowest in the 9 years of Farm Monitor, which is not surprising given cumulative years of drought and low soil moisture and very little irrigation in many regions as well. The other interesting thing is the labour efficiency, and regardless of whether you look at it in terms of cows per FTE or solids per full-time equivalent, we tend to see that the south is much more efficient in terms of labour use than the north. Labour efficiency in the north was lower this year than the previous year. The south managed to at least maintain their labour efficiency. So some of these characteristics play into the results that we see as we work through the presentation. Just quickly, I know we've got people in the webinar who this is second nature to, but I just want to quickly step through the dairy farm monitor method so that everyone understands the terminology and how we derive some of these numbers. So it's very much obviously looking at milk income, which is predominantly about 90% plus of a farm's income, which is obviously production times price. Then we take into account other income such as livestock trading profit and other farm income, whether that's fodder sales or farm rental, cottage rental on the farm, and that gives us our gross farm income. From here, we take away our variable costs. So in a dairy business, our herd, shed and feed costs. And with feed costs, we also take into account feed and water inventory changes. So just quickly, if you've had more feed on hand in terms of, hay or silage in the shed at the end of the year than you did at the beginning of the year, you've produced feed at it and it's incurred a cost, but it hasn't been used in the production of milk in that financial year. So it will appear in a cost of production as a negative. So it's not included in the cost of producing milk, but it will sit on your balance sheet as an asset. So our gross farm income, taking away the variable costs, gives us our gross margin. And from here, we take away overhead costs, both cash and non-cash. So cash being repairs and maintenance, insurance, paid labour, etc. And then we have imputed labour. So we don't look at drawings within a business. We try to standardise the cost of labour in the calculations. So we have an imputed labour cost. We also factor in depreciation. And this gives us our earnings before interest and tax, which we also refer to as operating profit. To get return on total assets, we divide our EBIT by the value of all the assets managed in the business. So whether it's owned or leased land or leased assets to get return on total assets. If we come back up to EBIT, we then from here take away our interest and lease costs. Now leased land costs are counted as a finance cost, not a feed cost. Agistment is a feed cost, but not lease of land. This is really a cost of accessing capital. This gives us our net farm income, and if we divide this by our equity in the business, we get our return on equity. Just quickly, true cost of production obviously factors in some non-cash costs, and our EBIT is often referred to as operating profit. So some of the factors influencing the results for the 1920 year, milk price played a huge role. We can see that on average it was up 14.7% on the previous year. And this was obviously driven by the effects of drought and reduced supplies to processors, so more competition in procuring milk from the processors. The cost of concentrates, look, they were still ridiculously expensive, but they did start to soften on the previous year. And then also the cost of purchased fodder, again, very high levels, but they did start to come down as well. I should also point out that these figures factor in the fodder rebate subsidy, so that is taken off the cost of purchased fodder. And then our homegrown feed costs were up on the previous year. probably primarily driven by, the costs were probably still incurred, but the amount that was produced on farm was not as much as it would have previously been with lack of moisture and rainfall. So the results in terms of EBIT in dollars per kilo milk solids on the left, and I have scribbled down cents per litre for those of you that are paid in cents per litre or more comfortable in cents per litre. In the statewide average was $1.05 per kilo of milk solids, which translates to about 8 cents a litre. In the north, this was 69 cents per kilo milk solids, or about 5.5 cents a litre. And in the south, it was up to $1.43 per kilo milk solids, which is about 10.5 cents a litre. So just for context, the previous year, the 18-19 year, our EBIT was, I think it was 38 cents a kilo milk solids on average across the state. So a great turnaround. Now, some of the key drivers, obviously our homegrown feed costs in this financial year, they took up about 54% of our total costs. And there's anecdotally, there's stories of a few, or probably quite a few businesses in that year, the milk check would come in and most of it would go out paying for purchased feed. What I've done here is look at our feed source between the north and the south, and also the top 25%. This green section of the donut here is homegrown feed. So the dark green is directly grazed feed, and the lighter green is homegrown fodder. So in the north, that was 55% of the cow's diet, and the rest of it was purchased feed. So whether that was purchased fodder, purchased concentrate, or other feeds. So total purchase feed cost was at $3.90 per kilo milk solids, which is quite high. For the south, same thing again, directly grazed and homegrown fodder, and they had less of that in the cow's diet, more purchased feed, but the cost slightly lower than in the north. Some of that is due to sort of proximity to the fodder market. Can cost upwards of $50 a tonne to get feed from, to get feed up to some of the northern regions in New South Wales. The top 25%, and I'll explain a bit more about the top 25% later, but they are 9 farms in the data set. 7 of those 9 farms were from the south, and we can see they had nearly 60% homegrown feed in the diet, so consequently less purchased feed, but also at a lower cost. Other overhead costs. Obviously, we want to try and control overhead costs in our businesses. It just gives us more opportunity to spend money in areas that are going to drive milk production. So on average, for the 19-20 year, they were up on the previous year. The largest component of our overhead costs is our labour costs, paid and imputed. So total labour costs, I think they're about 60% of our costs in this financial year. Now, most of this increase seems to have come from the north in labour costs, and what it looks like is that on average the average number of labour units on the farm stayed the same, but obviously in terms of per cow or per kilo milk solids, it was less efficient. There was also a small increase in repairs and maintenance, but nothing huge. So it was really the labour cost. Now the next couple of slides are going to show the individual farms in the data set. So I have operating profit or EBIT in dollars per kilo milk solids on the left and cents per litre on the right, individual farms listed along the bottom. Now there's going to be variation in these data sets, as we will see, and some of the variation is for lots of different reasons, but with the farms with a negative EBIT, I think it's important to remember that this doesn't necessarily mean a negative cash position, because we have got some of those non-cash costs, our imputed labour costs and depreciation, etc. For some of the businesses, and obviously I'm not speaking to individual businesses here because they are anonymous, but obviously there's some of those non-cash costs have played a factor, and also exposure to the fodder market and having to buy in lots of purchased feed has also influenced some of this performance. So here's our average EBIT of 69 cents per kilo milk solids in red, and this is the performance in cents per litre. For the south, the same graph and a stronger performance on the whole, but still variation for reasons explained previously, and that higher average operating profit of $1.43 per kilo milk solids, and there again in cents per litre. So as I mentioned, we've got 9 years of data now, so this enables us to have a good look at some of the trends over time. So if we look at EBIT over the 9 years, this is in actual dollar value and real dollars, so adjusted, we can see in the north, EBIT tends to float around $50,000 to $150,000 on average per farm, and there's a bit of variation, but not a huge degree of variation. In the north, they tend to be much more profitable, primarily. I mean, they've got a lower milk price, but their cost of production, they manage to have a slightly lower cost of production than what we see in the north. And I guess one of the key things here, the performance in the south has really sort of taken a hit since the milk price drop, and then cumulative years of drought, until we've finally had a very pleasing turnaround this last financial year. If we look at the performance in terms of return on total assets, return on equity and milk price, so milk price will be on the right, across the 9 years of the project, we see our return on total assets is pretty much mirroring our EBIT line that we saw earlier. Obviously it's EBIT divided by return on total asset, the value of the total assets managed. And return on equity, obviously we're taking out those interest and lease costs. So it's quite similar in the north, a similar trend on return on assets. And if we look at milk price in dollars per kilo milk solids, it's an interesting story. We see we've got the highest milk price in the 9 years of the project, obviously driven by a shortage of supply. So unfortunately, because the high milk price was for a reason, cost of production was still quite high, so we didn't quite see the higher return on asset as a result of a higher milk price due to the influence of drought. In the south, similar graph or same graph. Again, there's our return on total assets. Our return on equity, pretty much the upward spike here, it's a little difficult. We've got the return on equity is kind of affected by the capital structure of some of the businesses in that southern data set. So for example, we've got quite a few lease farms, which means their equity in the business is perhaps a bit lower, but a strong EBIT giving them, net farm income, meaning a higher return on equity. If we look at milk price, again, that upward trend as a result of drought. I mentioned earlier the top 25%, they are based on return on total assets, and 7 of the 9 were from the south. Obviously, some of these farms have irrigation, and depending where you were, there wasn't particularly, it wasn't full allocation, so there was a degree of water available for irrigation in some parts. Production across these farms varies quite a bit. but we've got 7 of the farms between 2 and 5 million litres. Average number of cows 489, with 572 kilos of milk solids per cow on average. As I mentioned earlier, nearly 60% of their energy coming from homegrown feed, and probably lower variable costs on the whole, but slightly lower feed costs than the state on average, and higher labour efficiency, which enables them to have this strong performance, strong EBIT of $2.60 per kilo milk solids, which translated it into a high return on assets. That sort of wraps up the summary of the results for the 1920 year. What I decided to do for this presentation was to I'm making the wild assumption that the drought has ended, and fingers crossed that it certainly has. We have seen a bit of a dry patch in some parts of the state in the last couple of months, but hopefully the drought is over. So what I've done, just out of curiosity, is to look at the last 3 years, which I'm calling our drought years, for the farm monitor performance compared to the previous 6 years of the farm monitor results. Obviously, there was volatility in those previous years. There were milk price challenges, and there were other droughts, but not as severe as what we saw over the last 3 years. So to start with, I've looked at our cost of production over the whole 9 years, and we can see there's a sort of disturbing trend upwards on average in New South Wales, which there's been a bit of a kick with the effect of drought. We see the north, as we're aware, has a higher cost of production than in the south, and then this is our top 25% of farms. But if we look at from the beginning of the drought, we can see see the impact of the drought on our cost of production. I think if we look at, in the south, we were bubbling around sort of just over $5.50 per kilo milk solids and up to $6.50 in terms of cost of production. In the north, probably sort of averaging around that $7.50 per kilo milk solids, but it's really kicked up with the effect of cumulative years of drought. Hopefully we start to see that turn around with the ability to grow more feed and softening of grain prices, particularly with a good harvest, and less reliance on purchased fodder. And just looking again at that, reliance on the purchased feed market, we see in the first 6 years of Farm Monitor, the farms averaged 60% of homegrown feed in their diet. The last 3 years, it's been 57%, which might not sound much, but I think much of a difference. But the real sort of kicker was in the last financial year, with cumulative years of drought, reduced soil moisture, and 51% of homegrown feed in the diet. And then, our feed costs, total feed costs, across the period, averaging $3.29 per kilo milk solids in the first 6 years, and the highest $4.79 in the last financial year, but over $1 per kilo milk solids increase in total feed costs as a result of the drought over those 3 years. How does this translate in terms of operating profit and EBIT? The last 3 years, we've seen a return on total assets average 1.6%. The preceding 6 years, it was 2.4% and 2%. Sorry, I've got a thing hiding my screen. Averaged over the 9 years. In terms of operating profit, just under 60 cents per kilo milk solids throughout the drought years, 81 cents the preceding 6 years, and that's meant an average of 73 cents per kilo milk solids over the duration of the project. So I hope you found that interesting. It was certainly something that I was curious about, and it's good to be able to put some numbers to the effect of the drought. What we saw in that 1920 year was obviously a decline in milk production, down 3.3%, which was about 1.04 billion litres in New South Wales, which was obviously down on the preceding year again. The milk price was up with all processors due to our strong competition for milk. Obviously, as an impact of the drought. And I'd just like to highlight, not only did we see restrictions to irrigation, but in various parts of the state, it was quite incredible. People were running out of stock water, which was a huge challenge, and that February rain really did save the day. There was sort of 11th hour stuff for some dairy businesses, particularly along the coast, with very little water available. Our grain harvest is looking fantastic, thankfully, which is seeing a good softening of grain prices, which will play into performance this year and next. I think we've been very lucky that despite the drought, cattle prices have remained very strong, which in some instances has helped farms with cash flow, but often we see with drought, we see cattle prices fall away as well. So that has been a saving grace for many. And as a result of that good autumn rain, we did see, particularly in the north, fodder inventories built up. Unfortunately, in the last, where are we now, December, over the last couple of months, some people have had to chew into that fodder inventory along parts of the coast due to rainfall disappearing. But in the last week, we've seen an extraordinary amount of rain across in the north. So hopefully that will turn around without too much damage. And look, this just sort of highlights the turnaround that we've seen. This is the dairy farm up at Wingham, 12 months apart, and it's quite stark, the contrast, thankfully. And obviously a lot of silage and hay had been made in that at the end of the year. So in summary, good EBIT. It's the third highest EBIT in the 9 years of the project, so that was a relief. The strong milk prices really drove that performance, outweighing the higher costs in businesses. And hopefully we're going to see, cheaper homegrown feed and more of it across farms. And it's really an opportunity now to build inventory and reduce the impact of those feed costs in our businesses. We do a survey with farms in the data set, and not surprisingly, we sort of, the outlook is positive from the vast majority of farms in the data set. No one is predicting a decline in milk production and improving profits. The others are sort of saying stable profits, so improving and stable profits. And I guess now, look, it's really an opportunity for people to reduce debt, particularly that unsecured debt that might have accrued over the drought, rebuild equity and recharge yourself. It's always easier looking at green paddocks than brown paddocks. So thank you very much, and I'm happy to try and address any questions if there are any. Thanks, Nico.
Thank you very much, Sheena, for that presentation. Fantastic insights. I've heard it a couple of times, but I don't get bored about learning and getting more data insights into what happens in businesses across New South Wales. So as we mentioned, we will have some time now for questions. If anybody has any question, you can type it in the chat box, or you can kind of request to speak, raising up your hand, and I can unmute you. So please feel free to do so. There's been 2 questions come through. One is, where can they access the report? And I guess that's the website that is on the screen at the moment.
Yes, they can access it on the website, Nico. if you are desperate and old school like me and prefer a hard copy, I am happy to email out a hard copy because I actually finally have it in my hot little hands right now. So if you would like a hard copy, feel free to call me or email me. My email address is up there as well. I can send one through. Yeah, more than happy to do that.
Perfect. The other question that you tapped towards the end that you mentioned around profit is the one, what are the expectations for this current year around costs and structures? And I know part of that is captured in the survey that they asked. Do you want to make any further comment there?
Oh, look, I think we're still seeing, I guess in terms of milk production across the state, it is starting to increase, looking at Dairy Australia reports, but we're still not at levels we were. So I think, to my mind, we're going to see, in the short term at least, good milk prices, which should give people confidence. And obviously we're seeing a great grain harvest, and concentrate prices will or have already fallen, and people are able to grow more homegrown feed. So I think it will be interesting to see what the performance is this year, but look, let's hope we improve on the $5 EBIT average across the state, because I think it is a good opportunity while we've got a strong milk price, and input costs softening. So there should be some great opportunity and positivity in the industry, I think, Nico. Obviously different farms have different structures and different risks that they need to manage, but on the whole, I think that it's great opportunity, great times for the industry, while we've got a situation like we do.
Excellent. I think that's it. There will be some couple of minutes towards the end of the webinar if anybody has any other burning question, but I want to thank you once again, Sheena. Do you want to make any quick reference to the Dairy Business Support Project, given that we have you
Yes.
on the screen at the moment?
Sure. Thanks, Nico. Yes. So at the moment, there's a project called Business Support Services being run. Now, it's a project being delivered by Dairy New South Wales, but also in the Murray Dairy and subtropical dairy regions. And it's with funds from New South Wales DPI to help support businesses in the, I guess, in business management, but particularly areas like if people are interested in getting their data into Dairybase or understanding their data in Dairybase, help with chart of accounts. We have an exceptionally good dairy chart of accounts, which makes understanding and managing costs in your business much easier and much more transparent. And if you're using things like Dairybase or looking at things like Farm Monitor results, it makes it much more easy to interpret. What else? Budgeting type opportunities. So yeah, it's sort of a financial focus. And you can either get in touch with me or any of the extension staff in Dairy New South Wales, Greg or Carly, Potts in the north, or Alicia Richter's in subtropical, and I'm not sure who it is in the south, whether it's Lachlan Barnes down at Murray Dairy, and they have engaged numerous consultants across the state to come and sit with you on farm. It's a one-on-one consultation to implement whatever it is that's going to help you understand your business position or manage your business position a bit better.
Perfect. There's a last minute question that came through. Did the extra cents charged by the supermarkets actually make it back to the farmers?
It did, depending on which farmers you were and which processor you supplied. But yes, it did. Farmers did receive payment, and as far as I'm aware, still continue to receive a sort of supplementary payment in their income, milk income.
Excellent, Sheena. Once again, thank you very much.